Welcome to the deep dive. We're jumping into some source material today. Seems like a recent article has definitely sent a few shivers down spines across Wall Street.
That's right. The topic for this deep dive is a proposed U.S. law, specifically a provision called Section 899.
Section 899, okay.
And it's tucked inside something, well, rather grandly titled the One Big Beautiful Bill Act.
Okay, One Big Beautiful Bill Act. Let's try and unpack this. Our mission really is to dig into this article you shared, pull out the crucial bits about this bill, about Section 899.
Yeah, figure out what it actually is.
Right, who it might hit, and why the experts quoted in this source material seem to be paying such close attention.
And it's important, the source material gives a pretty stark warning right up front. It suggests this isn't, minor tax code stuff.
Okay.
It warns this could be as significant to investors as, say, tariffs or duties, even goes so far as to say it could be weaponizing the American tax system.
Weaponizing the tax system. Wow, that certainly grabs your attention. So let's start right there. What exactly does the source tell us about this One Big Beautiful Bill Act, and, well, specifically Section 899 within it?
So the article identifies this act as including, and this is a quote, the most sweeping changes to the tax treatment of foreign capital in the U.S. in decades.
Sweeping changes,
Yeah.
Decades, okay.
Yeah, and Section 899 is the specific bit causing all this concern we're diving into.
Got it. And legislatively, where does this stand? Has it, gone anywhere?
Well, the article notes it actually passed the U.S. House of Representatives just last week.
Passed the House.
But, and this is crucial, it still needs Senate approval to become law.
Right. So moving, but not a done deal yet. What's the purpose then? What's Section 899 trying to achieve? Who's the target?
The aim, well, according to the source, is to hit entities from what it calls discriminatory foreign countries.
Discriminatory. Okay. Discriminatory in what way? How does the source define that term?
It defines them as countries that impose levies, taxes, basically, that disproportionately affect U.S. companies.
Ah, okay. Like those digital services tax we've heard about.
Yeah.
The ones targeting big tech.
Exactly. The examples provided are specifically those DSTs.
Does it name names? Which countries?
It mentions France's 3% tax on revenues from online platforms. Notes it primarily targets, the big names, Google, Amazon, Facebook, Apple.
Right.
And it also notes Germany is reportedly considering something similar, maybe 10%.
Okay, so the idea is pushback. Using the U.S. tax system against countries whose taxes are seen as, well, unfairly hitting U.S. firms. How would this U.S. tax actually work then on the investors from those countries?
The mechanism described in the source is quite direct. The U.S. would increase taxes on the U.S. income earned by investors from these discriminatory countries.
Increase taxes by how much? Is it like a one-off hike?
This is where it gets really interesting. The tax rate would actually increase by 5 percentage points
Okay.
each year.
Each year.
Yeah. The article notes this could potentially take the tax rate all the way up to 20% over time.
5 points annually, compounding up to 20%. That's a significant escalation.
Yeah.
So what kind of impact are we talking about here? And who exactly might get caught up in this?
Well, the source quotes Max Levine from the law firm Linklaters,
Yep.
and he says it could significantly increase tax rates applicable to certain non-U.S. individuals and business, governmental, and other entities. So the scope is broad.
Governmental entities. Hold on. You mean like actual governments, central banks?
Yes, exactly. According to the article, it could ensnare governments and central banks. And these are often huge investors, right? Especially in U.S. treasuries, U.S. government debt.
U.S. Treasury. So countries holding a lot of U.S. debt could potentially see the income from those bonds taxed more heavily by the U.S.
Precisely. The source gives a specific example, France and Germany. Combined, they held $475 billion worth of U.S. government bonds as of March.
$475 billion.
Yeah. Those considerable holdings could potentially face increased U.S. tax under this.
And taxing the income from those bonds, that effectively just lowers the return they get from holding U.S. debt, doesn't it?
Exactly. You've got Emmanuel Cao from Barclays quoted saying the mere passage of this could make dollar assets like treasuries less valuable for foreign investors.
Just the passage, even before implementation.
That's what he suggests. And George Saravelis from Deutsche Bank adds that for those affected investors, the de facto yield on U.S. Treasuries would drop by nearly 100 BPs.
100 basis points, nearly a full percentage point drop in yield just from the tax. That sounds huge in the bond world.
It is huge. And Saravelis also talks about the bigger picture for the U.S. itself.
Right. What does he say?
He's quite clear there would be an adverse impact on demand for USTs, that's Treasuries, and funding the U.S. twin deficit.
Our budget and trade deficits.
Yeah. At a time when, frankly, foreign buyers are pretty crucial, it really highlights a potential challenge for U.S. government financing.
So it's not just about hitting foreign investors. It can actually make it harder, maybe more expensive, for the U.S. government to borrow money itself. What other reactions, what other concerns does the source highlight?
Well, the language used by the experts quoted is pretty stark overall. George Saravelis at Deutsche Bank again. He sees this as potentially allowing the U.S. to transform a trade war into a capital war.
A capital war?
Yeah. He calls it weaponization of U.S. capital markets into law. Says it challenges the open nature of U.S. capital markets. Strong stuff.
Weaponization of U.S. capital markets. That is really serious language coming from a major bank. Who else? Does the source mention other concerned voices?
Emmanuel Cao from Barclays again. He also flags the risk for companies, specifically companies that make money in the U.S. but are based in countries with these digital services taxes, the DSTs,
Okay.
or countries implementing the OECD's undertaxed payment rule, the UTPR, that's another international tax rule, adds another layer of complexity here.
Right. Did he give any specific company examples that might be affected?
He did. He pointed to London-listed Compass Group. They do catering, lots of U.S. operations, and intercontinental hotels. Again, loads of hotels in the U.S.
So big international companies with significant U.S. income, potentially caught if their home country is deemed discriminatory.
That seems to be the concern, yes.
And if these taxes make U.S. investments less attractive,
Yeah.
could that actually lead to money leaving the U.S. capital flight?
Cao suggests that's a real possibility. He talks about the scope for capital outflows if indeed S-899 passes through the Senate in its current form.
Okay.
And he notes this is particularly worrying given, the U.S. net international investment position. It's sharply negative.
Meaning we owe the world more than they owe us, basically.
Pretty much. So capital outflows would just make that worse.
We also saw Beat Whitman from Port Advisors quoted in the source. What was his take on it?
He didn't pull any punches either, called it very bad, huge, said it's completely consistent with what this administration is all about.
Consistent.
Yeah. But he also emphasizes that, opinions are one thing, but the ultimate judge for this is the bond market.
The market decides.
Right. And he points to recent weeks where investors, apparently looking for a safe haven, have preferred German bonds over U.S. treasuries, suggesting the market might already be factoring in these.
Okay, so we've got significant concerns highlighted in the source. Experts from banking, law, wealth management, even pension funds. Where does the bill actually stand right now past the House, you said?
Correct. It's now over in the Senate. And legal experts quoted specifically from Mayor Brown suggest that significant changes could well be made there.
Right, as part of the Senate process.
Exactly. It's far from a done deal, and the final version, if it passes at all, could look quite different.
Okay, so lots of uncertainty still.
Definitely. And the Mayor Brown experts also raise a specific question, whether provisions that actually override existing tax treaties could end up in the Senate's version.
Overriding treaties. Wow, that adds yet another layer of complexity and potential international friction.
Absolutely.
So let's try and quickly pull this together based on our source material. We have Section 899, a proposed U.S. tax provision that's aimed at so-called discriminatory foreign countries.
Right. Potentially hiking taxes on investors from those countries by 5% each year, maybe up to 20%.
And it could affect a really wide range of entities, individuals, businesses, even governments and central banks holding U.S. debt.
And the experts quoted in the article, they view this with, significant concern, using terms like weaponization of U.S. capital markets.
Yeah, and warning about potential negative impacts on demand for U.S. treasuries, on capital flows. The stakes seem pretty high, according to this source.
It definitely highlights the complexities, the potential ripple effects when tax policy is considered as a tool, maybe even a weapon in international economic strategy.
Absolutely. It raises some pretty fundamental questions about open capital markets if tax policy becomes a direct instrument in these kinds of disputes.
For sure.
And that leaves us and you with a lot to think about. Based on these potential impacts on global capital flows, on government bond markets, all discussed in this source material. What do you think are the broader implications when tax policy gets used this way, as a tool in international economic strategy? Something to mull over as this situation develops.